Now we'll move on to keynote speech number 4. Mr. Erik Hilde, from Global Head of External Strategies from Norges Bank's Investment Management. He will give a presentation on investing with external managers. Mr. Hilde, the floor is yours. Mr. Hilde, you may be on mute.
Can you hear me now?
Yes, perfect.
Oh, thank you. There you go. So good afternoon. So my name is Erik Hilde. I'm heading the team selecting and monitoring external managers in the Norges Bank Investment Management, or MBIM. I'm very happy and honored to be invited here today to give you a short overview on how we in MBIM look at investing with external managers. So first of all, if we can turn to the first page there. Let me just give you a very quick overview of MBIM. So we are managing the Norwegian government pension fund, also called the Norwegian Oil Fund or Government Petroleum Fund, or Norway's Sovereign Wealth Fund. So, you know, in Norway, we say that a highly loved kid has many names. Anyway, we are a global organization with 530 employees, with offices in Tokyo, Shanghai, Singapore, Luxembourg, London, Oslo, and New York. In addition, of course, to over 100 external managers in 50 cities around the world. 72% of the investments are in equities, 25% in fixed income, and 3% in unlisted real estate and renewable energy infrastructure. The equity portfolio is $1,000 billion, of which 22% is in Asia, and 33% of the Asian equity portfolio is in Japan. So yes, we are a fairly large investor in Japan today. We go to the next page. Currently, most of the mandates that we award are country mandates in emerging markets, like Indonesia, South Africa, Peru, etc., and small cap country mandates in selected developed markets, like Japan small cap. This hasn't always been the case. We started out in '98 with investing with regional mandates like Pan Asia, Europe, etc. And then we have adapted our process and strategy to a changing world since inception 25 years ago. If we go to the next page. So today we have 100 portfolio managers based in 50 cities around the world. All of these managers are highly specialized. They are experts in their selected market segments, focusing on the market where they are based. For example, the external managers focusing on Japan, they are based in Tokyo, living and breathing in the market, knowing what's going on with the companies they invest in and the companies they stay away from. They know the management of these companies. They know the competitors, customers, suppliers, etc. So we very much believe in deep fundamental research as a way to find the companies to invest in. And for doing that, it certainly helps talking the same language and also understanding the context in which the information is given. For some markets, like Japan, I find it especially important to live in the same market. Next page, please. So when selecting external managers, we prefer small, privately owned organizations. In fact, close to 60% of our managers are such organizations. or where at the time of selection. So we have learned that excess return is tied to individuals. And these individuals, they need an investment organization where they can thrive. And that is, so to say, very seldom in large bureaucratic organizations. Our experience is that the smaller, privately owned investment organizations, they are better at attracting, retaining, and growing talent, which is a good fundament for a stable team. In some cases, it is due to better incentives or maybe more aligned incentives. In others, it is just that they are less bureaucratic. So we are shying away from the large financial institutions, shying away from the bank-owned and insurance-owned, and invest with the smaller, privately owned investment management organizations. Next, please. We prefer being an early investor in external managers and grow with them as they become larger. Actually, close to 40% of our existing managers were emerging managers when we first invested with them. There are a couple of reasons for why investing with startups or emerging managers, let's call it, fits well with our process, our focus and style. First, we don't look at past performance when investing with external managers. In fact, we don't ask for their performance. It is not that we don't care about performance. On the contrary, that is extremely important to us. But we don't think that past performance tells us anything about the future performance. So we analyze their portfolio on certain intervals to see what they invest in, to see when they change the portfolio, how they trade in and out of the names, when they take profit, what kind of risks they are exposed to, how they change the risk exposure, etc. And based on that analysis, we sit down with the managers in their offices and discuss the portfolio and market to see whether they do something differently than the rest of the market, and whether they invest in undervalued companies and construct an optimal portfolio. So I very much look forward to getting rid of this pandemic situation so that I can come visit all the different managers in Japan again. We have, and for the second, we have found that many of the emerging managers, they have a deep focus on investments as they build their track record. And that resonates very well with our focus on generating excess return through investing in the right companies. And third reason, both we and these emerging managers, they look for a long-term commitment. For example, Sparks, one of our external managers in Japan, has been our manager since 2001. Rios, one of our other external managers in Japan, with Fujune-san, which addressed to you earlier today. We have invested with them since 2008. That is 14 years ago. So at the time of selection, I can assure you, none of these were large. These were emerging managers. But we have had a long-term commitment with them. If we go to the next page, we prefer that our managers invest in concentrated portfolios. We don't think the risk is decreased by adding more names to the portfolio. On the contrary, the risk is decreased by reducing the names and thereby knowing the management, knowing the valuation, what is priced in, earnings potential, balance sheet, and all the nitty-gritty of each of the investments, each of the companies they are invested in. Next one, please. And we prefer to have one responsible portfolio manager for our mandate. We avoid rigid investment committees and look for managers where there is one person with ownership to the final investment decision. This sort of personal responsibility is especially important when it comes to the selling discipline. We have seen too many times that team decisions holds on to companies in the portfolio too long, as it is sort of not clear who is responsible for getting the stock out of the portfolio. So our excess return is mainly driven by single portfolio manager portfolios. If you go to the next page. And we prefer certain portfolio managers. I think especially being humble is very important. I think it's important to admit mistakes, that portfolio managers admit them and do something about it. I think curiosity is a very important trait for portfolio managers. You need to be able to challenge conventional wisdom to invest in the right companies, to go against the market. And third, I think the willingness to seek different data and ability to look for different interpretations is very important for the portfolio manager. So if you go to the next page, so to conclude, when investing with Excel managers, we use experts in selected market segments. We prefer small, privately owned organizations. We prefer being an early investor in this investment organization. We prefer that they have concentrated portfolios and that the portfolio is run by a single portfolio manager rather than a team or investment committee. Thank you.
Wonderful. Mr. Hilde, I think we have a couple of questions.
Hello. I can't hear you.
Thank you. So internet is Wi-Fi is a bit unstable. Amy,
okay.
Are you back? Amy,
Yes,
you back?
I'm here and I have been here. So I think there's a question for Mr. Hilde. Maybe I'll read this out. To grow talent for emerging managers, what are the important factors, particularly from the viewpoint of long-term commitment and training?
I think it's very important to have a close communication. We are meeting all the managers at their site during the year. We are never meeting any managers in our offices. We are seeing them at their site. We are sitting down with not only the portfolio manager, but the analysts, the CIOs, the CEOs, etc., and sit down and discuss how they select the different stocks to have to put into the portfolio, and how they do the analysis. And I think having this relationship and knowing what they are invested in, knowing the risks in the portfolio, and be able to sort of sit and discuss with them how they do it, I think that's important.
Thank you very much. Thank you again for a great presentation, Mr. Hilde. We will be posting more information about today's seminar on the FinCity Tokyo website. Thank you everyone for joining us today and for the Tokyo Asset Management Forum 2022.